Welcome to the ABA program 20 years after the end of welfare, Workfare delivered through federal and state EITC systems, sponsored by the ABA Tax Section and Economic Justice Committee of the Civil Rights and Social Justice Section. We are delighted you have joined us for today's program. It is now my pleasure to introduce today's moderator, Marilyn J. Harbour. Marilyn J. Harbour is Senior Assistant Attorney General in the Oregon Department of Justice's Tax and Finance Section, where she primarily litigates corporate tax cases and appeals in the Oregon Tax Court and Supreme Court. Longtime member of ABA and the Tax Section, she serves as the ABA House of Delegates and is Vice Chair of the Economic Justice Committee of the Civil Rights and Social Justice Section. Please go ahead, Marilyn.
Thank you. I would like to welcome our three panelists today, Francine J. Lipman, Alexandra Thornton, and Michael Best. First, I will just say a few words about Francine Lipman. She's a professor at the University of Nevada at Las Vegas's William S. Boyd School of Law. She's been an accountant, a lawyer, a teacher, and a scholar. And during her career, she has served as a CPA in an international accounting firm, the CFO of a chain of retail jewelry stores, and she's practiced law with, I think, 2 firms. She is frequently a speaker on tax subjects to law and business groups, and is an elected member of the American Law Institute, the American College of Tax Counsel, and the American Bar Foundation, as well as being an editor and former committee chair for the tax section of the ABA. Alexandra Thornton, also known as Alex, is the Senior Director of Tax Policy on the Economic Policy team at the Center for American Progress. Prior to joining the Center for American Progress, she spent nearly a decade as a tax policy advisor to a U.S. Senator who served on the Senate Finance Committee. And she served as Executive Vice President for Policy, Planning, and Business Affairs at the Jane Goodall Institute. Thank you for joining us, Alex. Michael Best is the Senior Policy Advocate at the Consumer Federation of America. This is a consortium of 280 consumer groups where he leads the CFA's tax work with a focus on building and leading a coalition to promote the regulation of paid tax preparers at the state and federal level. Michael also coordinates the Federation's work on civil justice issues, focusing primarily on forced arbitration. All right, we're ready to begin. Francine, would you please give us an overview of the EITC and its history?
Yes, good morning, and I just want to thank the tax section as well as the Economic Justice Committee of Civil Rights and Social Justice. I think that the marriage of these 2 sections of the ABA in this presentation is truly Exhibit A of why tax and anti-poverty really is now the forefront of our current fight against poverty. What we are now doing in 1996 is celebrating since 1996, when we ended welfare as we know it. Now 20 years later in 2016, what we see truly is the end of welfare and workfare. We're also looking at 50+ years since Lyndon Johnson announced the war on poverty, and what many academic scholars as well as others have noted is rather than having a war on poverty, we're suffering to a certain extent a war on the poor with an increase in debtors type prison issues with the high cost of poverty. So to circle back this issue to taxes and how taxes truly are now the anti-poverty measure in our tool chest against fighting poverty, I want to reflect back on the 2014 measurement of poverty, both the official poverty measure as well as the supplemental poverty measure. So the screen, hopefully you can see the various anti-poverty measures and how they lift our population from poverty. So this is, again, 2014 data. The 2015 data has just come out, and the good news is the 2015 data reflects a 1% decrease from poverty as compared to the 2014 data. This slide indicates that of the 316 million Americans included in the population universe for which we measure poverty. And what's interesting to note about this is that about 9 million people are not included in this measurement. And I want to reflect briefly on this population. So the folks who are not included in this measurement at all include people who are in the military. So this is non-armed forces population, and as we know, unfortunately, many folks in the military do suffer poverty, but they're not included in this measurement. In addition, folks who are institutionalized through prisons are also not included in this population, as well as members of our community who are homeless, or also members who are in nursing homes. They're not included in this population. So while poverty measurements on their face might appear comprehensive, they're not. They also don't include people who are homeless. What's interesting about this measurement is that the most significant anti-poverty measure, as we all know, somewhat self-evident, is jobs, market income, including portfolio income, interest and dividends. But about 245 million Americans are lifted out of poverty with jobs. What's interesting to think about this is if we were to increase the minimum wage, another almost 5 million individuals would be lifted out of poverty. So while that is the marketplace, there are governmental things that we can do to potentially lift more individuals. As this slide really demonstrates, the most significant government anti-poverty program we have is Social Security. Of the 71 million folks who are not lifted out of poverty with jobs, with market income, 25 million are lifted out of poverty with Social Security. That clearly is the most significant and successful anti-poverty program we have. The other measurements here are unemployment benefits, which are derivative from work. By the way, Social Security benefits are clearly derivative from work, and that's Workfare. Unemployment benefits similarly are Workfare, as are veterans benefits. In the official poverty measure, the only measurement that is really not reliant on work is TANF. TANF is the post-1996 Workfare program welfare, and so TANF lifts less than 500,000 individuals out of poverty. It is the only cash benefit that, other than the Earned Income Tax Credit and the Child Tax Credit, that is not 100% reliant on work. This slide then demonstrates in the official poverty measure, which tells us for 2014 that 44.5 million individuals were living in poverty. You can see the official poverty measure does not take into account taxes, which, as we know now, is the most significant anti-poverty benefit that is a cash benefit. Clearly makes TANF, dwarfs TANF by comparison. So the second half of this slide indicates the supplemental poverty measure, and this includes taxes as well as in-kind benefits, meaning non-cash benefits that are lifting folks out of poverty. So as you can see, the Earned Income Tax Credit and the Child Tax Credit lift over 6 million individuals out of poverty. The Earned Income Tax Credit and the Child Tax Credit, refundable Child Tax Credit, are reliant on work. You do not get that benefit, as Alex is going to describe in later slides, and as I'm going to describe in a couple slides in a minute, that you need work and you also need children in your household to benefit from the Earned Income Tax Credit. By comparison, the other benefits on this list are all in-kind benefits, which means they're not cash. SNAP, WIC, and lunches are food benefits. And by the way, SNAP, which is effectively food provided in kind, is quite modest on an individual basis. The average benefit is about $127 per month. And if you do not have children, there is a work requirement. Otherwise, you only get SNAP, which is food stamps, for 3 months every 3 years. So as you can see, that SNAP, too, to the extent you don't have children, is reliant on work to a certain extent. Housing and electric in-kind benefits lift about $3 million. This slide, I think, is terribly reflective of, and someone just focused, Earned Income Tax Credit. You can get the Earned Income Tax Credit if you don't have children, but that benefit is very, very modest, and we're going to talk about enhancing that. The childless Earned Income Tax benefit is less than about $500 a year, and it's a very modest benefit. What's interesting about this slide is, again, medical expenses push about 9 million individuals into poverty every year, and the good news about that is the Affordable Care Act, with the expansion of Medicaid, hopefully will decrease this population being pushed into poverty. Child care and work-related expenses, as we know, impact many individuals, especially the working poor. Another 6 million are pushed into poverty with child care and work expenses, and perhaps this is an area where we can really work on, perhaps through tax credits on a going forward basis. Taxes themselves only push about 3 million individuals into poverty each year. And what's interesting, when you deconstruct this figure, you can really see that it is not federal income taxes, although childless workers, to reflect back on the fact the Earned Income Tax Credit doesn't really help childless workers. Childless workers are more likely to be pushed into poverty with federal income taxes, but the big number inherent in that tax figure is payroll taxes. Payroll taxes, as we know, impact $1, and many low-income people have significant payroll tax burdens. I'm going to move on to the next slide, and what's interesting about this slide, and I think reflective of why so many women and people of color suffer poverty is compared to men and the white population, is because, as you saw in the prior slide, what really lifts people out of poverty is market income and work. Workfare benefits that are derivative from your work. And if you look at overall median income, which means half of the population is below these figures, women suffer lower overall median income disproportionately compared to men, as well as do people of color. And so as a result, people of color and women are disproportionately poor because so much of our lifting out of poverty is dependent upon work. Now I've got this slide indicates to us that the population percentages on the left-hand slide of this these percentages are reflective of the population at large. The percentages on the right-hand side of each of these demographic groups is reflective of the population living in poverty, and consistent with the prior slides, because so much of anti-poverty benefits is reflective, based upon work, and women and people of color are disproportionately receiving lesser amount of market income. You can see the population of poor for people of color is disproportionately higher than their population at large. And so you can see this slide reflects the overall population as well as the populations living in poverty, and women, children, and people of color are disproportionately represented. I want to now look at an example and start to dig down a little bit into the Earned Income Tax Credit and the Child Tax Credit, some examples. What's really interesting, I think, is that in 2015, about 26 million taxpayers received $66 billion in Earned Income Tax Credit with an average benefit of about $2,500. If we compare this to Social Security benefits, which, as we can see from the prior slides, are really lifting enormous amounts of the population, including, by the way, children. About 2 million children a year lifted out of poverty with Social Security benefits. 60 million people received $883 billion in Social Security benefits, averaging about $16,000 a year. So when you compare the amount of resources that are spent on Social Security as compared to Earned Income Tax Credit, really is interesting. This is an example of benefits received based upon filing status and household makeup. So a single person making about minimum wage, $15,000 a year, pays about $500 in federal income tax. But look at the payroll tax burden, because that's on $1. By the way, this payroll tax burden reflects the employer and the employer percentage of payroll taxes, because many economists believe that the employee bears the burden of both halves of payroll taxes, and so that's why I'm reflecting it this way in this slide. You can see the single person without children gets 0 Earned Income Tax Credit, 0 Child Tax Credit, and so this is a person that is likely pushed into poverty with these taxes. By comparison, we see a married filing joint family with 3 kids making about $35,000 a year. Their federal income tax burden, because of the personal dependency exemptions and the standard deduction, is about 0. However, they are paying payroll taxes. Again, I'm reflecting the employer and the employee portions, which is about $5.4 thousand. But they get the Earned Income Tax Credit for 2015. This is about almost $4,000, $3.8 thousand. This is derivative from work. You don't get the Earned Income Tax Credit unless you have work. Child Tax Credit is about $3,000. You can see the $6,800 refund here, not including any withholding. Just offsets the payroll tax plus a little bit more. Head of household, which is a common filing status for single parents with 3 kids at $25,000. No federal income tax because of the deductions, but a arguably significant relative regressive payroll tax burden. Earned Income Tax Credit is higher here because of the filing status and the lower income, $4.8 thousand with about a $3,000 child tax credit. The child tax credit, by the way, is $1,000 per child But the child tax credit, in order to be refundable, is dependent upon work. 15% of any work dollars above $3,000. So again, both the child tax credit to be refundable and the earned income tax credit are derivative of work. So as a result, what we're seeing in our country is folks who are not able to work, they really fall off the cliff of any sort of benefits, and that is why we are seeing escalating percentages of individuals who are living in extreme poverty. And as a result, we need to be thinking more critically about how we can help these individuals. TANF doesn't seem to be doing it because, again, post-96, TANF really looks more toward work. And so we've got to think about individuals who are not able to work, to think about how we can lift them out of poverty. As I said previously, poverty has dropped in 2015 by about 1%. This seems to be because medical expenses are dropping to a certain extent because of the ACA, Affordable Care Act. We're also seeing a lift in some of the wages, which is wonderful, perhaps derivative from increases in minimum wage. And so thinking about going forward, how can we take this poverty data and try to fix some of the problems that jump out at us? Child care and work-related expenses, we've got to do better at trying to subsidize these and mitigate these costs. As I've said before, there have been many proposals, some of which Alex is going to talk about, where we can increase the childless worker earned income tax credit. Childless workers are the population that are still being taxed from a federal income tax purpose into poverty. The child tax credit, it's not indexed for inflation. We might think about increasing this, and we also might think about making it not derivative of work, making it fully refundable potentially, so that we can lift individuals who are taking care of children but are not able to work for one reason or another. Maybe they're people with disabilities or are just out of the job market, can't get a job. So we might think about making it similar to other countries like Canada, where they have a child allowance. And that is, I want to talk very briefly about state earned income tax credits. 26 states plus the District of Columbia have earned income tax credits that effectively piggyback on the federal credit. There are 8 states, including Nevada, that do not have income taxes on wages. So if you combine that with the 26 states plus DC that have some sort of wage subsidy, what we're seeing in the poverty data when you deconstruct the supplemental poverty data, we're seeing that state taxes do not seem to be pushing people into poverty. Some of these states have non-refundable earned income tax credits, which is very interesting to try to think about. That's not then helping the lower income individuals, but maybe middle income individuals. The states vary quite a bit, ranging from a 3.5% of the federal EITC to Washington, D.C., which is the greatest, which is a 40% credit. California has a very new state earned income tax credit, and that earned income tax credit does not include as wages self-employment income. Trying to mitigate some of the problems that the federal government has had with Schedule C income, and it generating an earned income tax credit. So I think it is very important for the federal government and the states to open up a healthy dialogue about how we can make the earned income tax credit more effective for everyone. And lastly, I welcome any questions you might have. If you don't have a chance to answer your question here, please do send me an email. I work actively and passionately on the front lines of tax justice, and I welcome your contributions to this conversation. We can all lift more individuals out of poverty, including children, and we want to do that together. So thank you so much, and I'm going to turn this over to Alex.
First, Francine, this is Marilyn. If you could explain why on one of your slides it shows all as being higher than either women or men. Let's see. Certainly. Oh, because all includes women and men, and that's actually a very good question. I thank that. Thank the person who asked that. The all that is a household number versus an individual number. So thank you for that question. I meant to clarify it, and I appreciate that. Good.
So it's
all
household right. As compared to individuals.
All right. Thank you. Alex, please tell us more about the EITC.
Okay. Well, one of the challenges we face with reducing poverty, of course, is getting people into the middle class and keeping them there. And it's important both for humanitarian reasons, but also because a robust and sustainable economy depends on a strong middle class. But it turns out that getting into and staying in the middle class is getting increasingly difficult. This quote is from a report that my organization, the Center for American Progress, did in 2014. We looked at the costs associated with the pillars of joining and staying in the middle class: health care, child care, college savings, and so forth, and found that those costs increased by over $10,000 between 2000 and 2012 for the typical married family with 2 children. And that was even as incomes remained flat. So that's the challenge that we have ahead of us. This chart, I won't go back over it in detail because Francine hit on a lot of it, but a lot of this brings together a lot of the information about gender, age, and race. This looks at 2014. It was in a report that CAP did. And the takeaways from it are just to summarize that there are more women than men in poverty. There are more children than non-elderly adults. And there are far more blacks and Hispanics than whites and Asians. This chart gives you an idea of the substantial mobility. The poor are not a stagnant group. This data was taken from 2010 to 2012, and it shows how many millions move across the poverty line in either direction every year. It turns out that about half of Americans will experience at least 1 year of poverty or be teetering on the edge of poverty at some point during their working years. And what this shows, it's a little bit complicated, but it looks at basically the population in poverty in 2009. And it shows how many in 2010 move out of poverty by 2010, and by 2011, and by 2012. And then it looks at the population who were not poor in 2009 and how many moved into poverty in 2010, 2011, and 2012. So that just gives you an idea of what we're dealing with here, where people are going in and out of poverty constantly. And it raises the importance of having some sort of automatic mechanism like we have in the tax code with the Earned Income Tax Credit. And also because income volatility is much greater among lower income households. families at the low end of the income scale are also less equipped to handle reductions in income, and they incur greater expenses as a result of having a drop in income, which of course further increases their chances of experiencing subsequent reductions in income. So it's a downward spiral. There was a study done by Lily Batchelder, a professor at NYU Law School, who estimated that families in the bottom quarter of the income distribution on average face a 44% swing in their income over the 6-year period she studied, while families in the top quarter of the income distribution only had about an 18% swing in their income. So I have a couple of slides here that I'm not going to go over in detail because I understand that many of you already know a lot about how the EITC and the CTC work. But I just want to point out that both the Earned Income Tax Credit and the Child Tax Credit, of course, as Francine has said, require the recipient to work. But the Earned Income Tax Credit is available from the first dollar, while the Child Tax Credit, a person has to make $3,000 or more before they can benefit, and it's phased in from there. The Earned Income Tax Credit is fully refundable, and as Francine said, the Child Tax Credit is only partially refundable. And then for both, the amount of the credit depends on a number of factors, including the level of income and the number of children. And the next two slides are just designed to show you how complicated that can be. The qualifying child rules for the Earned Income Tax Credit and for the Child Tax Credit are very similar, but they're different. And so when someone is at the low end of the income distribution and they're seeking these kinds of tax benefits, it can be very confusing to figure out how they go together and how they overlap. So then moving on to the next slide, it's important if we're using the tax code as a poverty reduction tool that we evaluate its effectiveness. And a number of people have done this, including the IRS, but also some independent researchers. And this slide shows a sort of framework for evaluating it. We need to evaluate it first in terms of efficiency. And with efficiency, we're essentially asking, how does it impact the decision to work? Are more people working because of this incentive? And do they increase the number of hours they work? In terms of equity, we want to ask how effectively does the program reduce poverty or reduce the income tax liability across gender, race, and age groups. And in terms of administrability, we want to ask, can the taxpayers for whom it was designed understand and use it? And can the IRS administer the program effectively? So as I said, a number of people have studied it, and I wanted to share just a few takeaways from that. First of all, the EITC does encourage single mothers to work. That was one of the reasons why it was enacted in the first place, and it is effective at that. The Earned Income Tax Credit does reduce somewhat the hours worked by a second earner in a married couple with children, according to some researchers, but that's not a very strong effect. The refundable portion of the credits, so of course when a recipient doesn't have enough tax liability against which to take the credit, that's where the IRS sends them a check for the remainder, at least with the EITC. The CTC is only partially refundable. Those refundable portions reduce poverty by an additional 3%, but the effects are not uniform across households, again, as Francine mentioned, especially for childless workers. Now, the greatest reduction in tax burden occurs in the $10,000 to $20,000 income range. And I wanted to move to the next slide to explain that in a little more detail. If you look at all of the federal taxes together, the federal income tax, payroll taxes, excise taxes, etc., you can assess what the effective tax rate is with and without the EITC. And this is what the Tax Policy Center did. They're a nonpartisan group, by the way, that is a project of the Brookings Institution and the Urban Institute. And So here they have on the left column you have the income distribution, various income levels. And they take the effective tax rate without the earned income tax credit is the center column here. And then the third column is the earned income the effective tax rate with the earned income tax credit. And you can see as you look across that without the EITC and with the EITC, there's a substantial benefit from the EITC moving across. This here is the group that gets the greatest benefit, the $10,000 to $20,000 range. And when you get up to $50,000 to $75,000, you can see that the benefit levels off and goes away. So that's just interesting to see how effective it is at the different income levels. Now, another thing that has been found, like the IRS has looked at the earned income tax credit because there are folks who say, well, there's a lot of fraud and abuse with the earned income tax credit. And Michael's going to talk about that in greater detail later. I just wanted to lay out for you what the IRS analysis was. From 2000 to 2008, they studied this issue, and they found that the largest dollar errors were for people claiming a qualifying child that actually was a non-qualifying child. The most frequent errors were for misreported income, about 85% from small businesses who reported that they had less income than they did and therefore qualified for the earned income tax credit when they did not or didn't get as high a benefit. And then a third error was for incorrect filing status. People claiming they were married when in fact they weren't and getting a higher benefit than they should have. And then in 2013, the IRS found that 22 to 26% of EITC payments were issued improperly. Now, that doesn't mean they were completely wrong. They might have been a few dollars over or under. And again, Michael's going to talk more about that, but I just wanted to lay out those statistics for you. Now, Francine's gone over some of the reform proposals a little bit. I've just got a slide here showing the different reform proposals for the earned income tax credit that are out there. One, of course, as we've said again and again, is to increase the amount of the credit for workers without qualifying children. Another one is to lower the eligibility age. It's currently 25 years for earned income tax credit. People are generally in consensus about lowering it, but not necessarily about what age. At CAP, we propose lowering it to 18 so that people getting out of high school who aren't going to school, they're in the labor force, they're not claimed as dependents on another's return, can benefit from it and hopefully improve their situation. Now, a lot of people have complained that the earned income tax credit, and rightly so, only comes at the end of the year. It comes after the end of the year, actually, when you file your tax return. And that doesn't do a lot of good during the year, of course. And some years ago, there was an effort to provide an advance EITC. And the idea was that the employer would help administer a monthly payment in advance of the EITC. But there were many problems. It was very complex. Employers didn't like to have to do it. And there were some instances where at the end of the year, people would find out that, oh, they made more money than they expected and didn't qualify for as high an EITC or perhaps none at all. And the IRS would have to recapture that payment. So that wasn't good, and effectively it was dropped in 2013. But there's still this problem that, for many people they have an emergency need for cash. And so we proposed at CAP an early refund of $500 that would be available after July 1, at which point a person would have a pretty good idea of whether they were going to qualify for the EITC. And the $500 amount is based on our finding that the average payday loan is about $375. So the idea here would be to prevent people from having to get a payday loan if they could just get a $500 early refund of their EITC. And we view this more as insurance, not as a wage supplement idea. And it could be used for mobility opportunities too. For example, someone who wanted to send their child to a summer enrichment program could get this early refund of $500. And its success would be of this program, if it were ever enacted, would be measured by the decline in the number of families seeking help from predatory lenders. Finally, I mentioned a couple other ones here. The idea of making it easier for EITC recipients to be eligible for Pell Grants by not having to prove that they're eligible, but rather just to say categorically that EITC recipients are eligible for Pell Grants. And then also to harmonize the EITC with the Savers Credit, which is a non-refundable matching credit that the federal government gives to low-income savers. Many people don't even use it because they don't have income against which to take it. And it would be nice to harmonize that with the EITC so that these folks could begin to save. With the child tax credit, the main proposals that I'm listing here are to make the child tax credit fully refundable. Right now you only get 15% of income over $3,000 up to a cap of $1,000 per child. It's complicated to calculate, and it really, if it's for the benefit of children, it should be fully refundable. It should be indexed to inflation like the EITC now is, and it should be made available on the first dollar of income instead of a person having to make $3,000 before they can begin to get it. At CAP, we propose just eliminating this income requirement. It seems a little strange to require a benefit that's for children to be based on work. And then another proposal that I wanted to talk about, because it has received some interest and there are a couple of bills now in Congress, is a proposal that CAP made a couple of years ago for a young child tax credit. You know, families face significantly higher rates of poverty and economic insecurity during the first 3 years of their child's life. And economic instability and poverty are actually highly detrimental to children's long-term health, educational, and employment outcomes. This is something that's been researched, and there's data on that. In 2013, nearly 23% of infants and toddlers lived in households with incomes below the federal poverty line, so you can see what a problem it is. And it does seem that the child tax credit should increase during the stage when a family's needs are greatest, when children are young and earnings are relatively low. So CAP proposed a supplemental young child tax credit for children under 4 years old. It would be an annual amount of $1,500, but administered on a monthly basis, paid monthly through direct deposit and direct express. And so that's something that I just wanted to put out there as another proposal because it has been taken up. How am I doing on time here? Okay.
You have time.
Okay, good. I will go on then and take a look at some of the policymaker proposals that are out there. One that has received some attention is the House GOP tax plan. It's a pretty dramatic change because it makes a larger standard deduction. It retains the EITC in its current form, and it repeals all personal and dependent exemptions. And I raise this one because if you look at this proposal, it does retain a child independent tax credit, and it increases it, but the increased amount is small and it's non-refundable. And I raise this, the one point I want to make about this proposal is how important it is to be cautious about proposals that seek to provide tax simplification at the low end of the income distribution, and B, to be aware of the importance of evaluating tax proposals in their entirety. And it turns out that the Tax Policy Center looked at the House GOP tax plan in its entirety, looked at the full effects of the plan, and they did it for 10 years, but I'm just showing you the fully implemented year of 2025, 10 years out from when they did the analysis. And as you can see, there is some benefit, a lowering of the federal tax for the first 3 income quintiles. But you get down here to the 4th income quintile, which is about $68,000 of income up to $112,000 of income for a family. And they actually have a tax increase, whereas the top quintile and the top 1% have a very substantial decrease in their taxes. So it's very important to look at proposals in their entirety. Another proposal, or another set of proposals, are those advanced by members of Congress. The idea of increasing the EITC for childless workers, as I said, is a consensus proposal. There are strong supporters of it on both sides of the political aisle. I have them listed here of the ones that I'm aware of. And then the young child tax credit I mentioned has been introduced, a version of it, in the House and the Senate. And moving
Alex,
just
before
yes.
you move on there, could you explain the effect of the Earned Income Tax Credit on childless workers? I think Francine mentioned earlier that they really don't get the benefit.
That's right. Basically, I had a statistic here which I am not finding very quickly. But basically, oh yeah, here it is. Childless workers are basically just workers, of course, that don't have children, and they're the only group with income substantially reduced by federal taxes. In other words, at the low end, all these other groups of people we've been talking about have their income increased because of the Earned Income Tax Credit and the Child Tax Credit. But they actually have their incomes reduced substantially by their tax burden when you take into account all the different taxes. And in fact, their EITC is very low. It's less than 1/10 of the credit available to families with 2 children. So that's why it's roundly agreed that the Earned Income Tax Credit amount should be increased for childless workers. Now moving ahead to the presidential candidates and their proposals, Secretary Clinton has proposed doubling the child tax credit for children under 5 and retaining the normal child tax credit for ages 5 to 16 and creating refundability from the first dollar of earnings for the child tax credit. And her proposal, she has other proposals as well, and her proposals together, they're relatively modest. She pays for all of them. And the good thing about them, though, is that they're very well targeted to families with very young children and to the lowest income families. Mr. Trump has a plan that, like the House GOP plan, and it's very similar to it, tries to create a lot of simplification for people at the low and middle end of the income distribution. I guess the middle isn't an end, but in any event, for low and middle income folks. And it repeals the personal exemptions, increases the standard deduction again. It gets rid of head of household filing status. And the combination of the proposals that Mr. Trump puts forward, actually it turns out, they were analyzed in particular by Lily Batchelder, the professor at NYU I referred to earlier. It actually turns out that there are pockets of people for whom the Trump plan actually increases their taxes. And that's true for about 7.8 million families with children, according to Professor Batchelder, which represents more than half of single parents. So again, it's just emphasizing again the importance of looking at the whole plan, because as you know, in the tax area there's a lot of interaction, so it's important to look at that. And that's all I had, Marilyn. Should we move on to Michael?
Yes, I thank you, and let's hear from Michael now on the unpaid preparers, or the paid preparers.
Thank you, Marilyn, and thank you to the tax section for the invitation, everyone for joining. So I'm Michael Best, the Senior Policy Advocate at Consumer Federation of America, and I'm here to talk about our work promoting the regulation of paid tax preparers, as well as some of the issues with preparer quality, add-on fees, lack of pricing transparency, and tax loan products that can end up reducing benefits from the EITC and other tax benefits. At CFA, we convene a coalition of national and state groups that promote the regulation of paid preparers, both in specific states and at the federal level. And what I want to outline for folks today is that we know there's a high instance of use of paid preparers. There's a high instance of problem with the returns paid preparers are preparing, and a lack of transparency in fees. And expensive tax time products may reduce EITC benefits. There's also strong public support for regs, for regulation of this industry, and I'll talk a little bit about some of our consumer poll work. And that really equals the need for more consumer protections in this sphere, and that the time is really right for that to happen. So CFA is a nonprofit association of more than 250 consumer groups that was founded in 1968 to advance the consumer interest through education, advocacy, and education. And I'll just start with the first part of my equation that I laid out for you, is that the use of paid preparers is very high, and most of them are unregulated. So in tax year 2011, 56% of returns were prepared by paid preparers. 59% of EITC returns were paid by paid preparers, and of that 59%, 74% of them were returned by unenrolled paid preparers. So a paid preparer that doesn't have any kind of professional accreditation or any kind of state regulation. I mean, those are the two options now for any kind of regulation, essentially, as there are currently no federal regulations. In 2014, 55% of paid preparers were unregulated, so the majority. So we know there's a high use of this industry by taxpayers, particularly low-income taxpayers. The next thing I want to highlight is that there are a lot of incorrect returns coming out of this industry. So there's a long history of both consumer group mystery shopper tests of paid preparers, as well as government tests. So on the left, you can see in yellow, these are consumer mystery shopper tests from 2008 to 2016. And on the right, in orange, these are government tests by both the Government Accountability Office and the Treasury Inspector General for Tax Administration. And you see the rates are really high. We have some, I should point out, we have a couple lower ones here on the left in the consumer mystery shoppers, and that was a little bit before my time working on this. My understanding is that those tests were actually designed to look at some of the issues with tax time lending that I'll talk about later, and weren't actually even designed to sort of capture an issue with paid preparer with incorrect returns, but they just happened to notice there were a lot of incorrect returns. So I've just included them so you have all the numbers that I have, but I wanted to flag why those, our understanding of why those look a little bit lower than most of them, which are pretty high, though even the lowest ones are pretty high. So you can see that there's a really, really high error rate going over a lot of years, both in consumer groups and the government. And what this really comes down to, how this ties into all the other EITC poverty issues we're talking about, is we really want to ensure that every EITC or other credit dollar is going into the hands of these low-income folks and not being diverted. These errors or potentially fraud, of course it's really hard to tell if it is fraud, so I usually just talk about it as errors, give the benefit of the doubt. This is a big deal for filers, right? I mean, if you get the EITC and it's claimed and you're later determined to be ineligible, you could lose the benefit for years. So it's a big deal, and even just I think the fines and the fees associated with an incorrect return if it's caught are a big deal for low-income households. So I want to shift gears a little bit and talk about sort of some of the issues around the business side of the paid preparer model that may crop up for low-income folks. So, while these are by definition we're talking about, we're concerned about low-income people. In aggregate, this is a large pot of money that's coming out every year, right? So I mean, this is a target for potentially unsavory business practices to get a piece of this. One of the things that we see are add-on fees. So they're fees that don't necessarily have anything clearly to do with the tax preparation themselves. Of the big three chains, H&R Block does not charge add-on fees. In 2016, Jackson Hewitt was charging a $20 data and document storage fee, and Liberty was charging a $9 add-on fee in 2013. That was down from $20 in 2012. The amount for 2016 was unknown. Preparers not associated with those large chains will often charge add-on fees with names like technology fees, transmission software fees, application fees. It's not clear what they're actually really for. You can see on to the right of this slide, I have a quote from a decision in US v. Instant Tax, where the owner of ITS called these fees junk fees and revenue generators. ITS was, or at least I think claimed they were the 4th largest tax preparation business in the country until they were barred by the courts several years ago from operating any longer because of fraud and deception. Traditionally one of the primary sort of tax time lending products that can be very expensive for consumers who are trying to finance their tax preparation was the refund anticipation loan. So these were loans made by banks, secured by and repaid directly from the proceeds of a consumer's tax refund. These are largely gone now. So between 2009 and 2012, well, the bank ones are entirely gone actually. Between 2009 and 2012, all banks left this space, either voluntarily or forced by regulators. What happened was the IRS stopped giving the debt indicator, which would tell lenders if someone was likely to have their refund intercepted for back taxes or something like that. And so these became much riskier. So some banks left on their own, and some banks were told by regulators they had to stop making them. After banks exited the RAL market in 2012, non-bank lenders like payday lenders started to make loans of this fashion. So these are not nearly as widespread though as the bank RALs were. Only 100,000 consumers applied for a RAL in 2013, and only 34,000 applied in 2014. Something that we just saw last tax season that's new is what are called no fee RALs. So this is a new product. So they're billed as advances that don't impose a charge on the consumer at all. We're sort of not sure how this is going to shake out yet, though, because there are things like these add-on junk fees. There's a lack of transparency in pricing generally in the paid preparer sphere, which I'll talk about more later. There's some concern that the cost of these advances will be passed on to the consumer in some way, though I know at least explicitly some of the lenders are saying that shouldn't be done, but it's not clear given the lack of sort of clarity in pricing and regulation in this market, how certain of that we can be. The last kind of RAL is a pay stub RAL. So these were loans made prior to the tax filing season, before taxpayers received their W-2s, can file their returns. In past years, Jackson Hewitt and H&R offered these, but it looks like only Block is offering the loans in this last tax season in 2016. The instrument, sorry, I had to forward here. So the instrument that replaced the bank refund anticipation loan as the main sort of tax time financial product is the refund anticipation check. So with a RAC, the bank opens a temporary bank account. The IRS direct deposits the refund check there. After the refund is deposited, the bank issues the customer a check or a prepaid card or makes a direct deposit into the consumer's own bank account and then closes that temporary account. It's not any faster than getting direct deposit from the IRS, but it allows fees to be deducted from the refund. So over 21 million consumers obtained a RAC in 2014 at a cost of at least $648 million. So, I mean, these aren't talked about as loans, but they most likely represent a high-cost loan of the fee. I mean, so if you pay $35 to defer payment of a $350 tax preparation fee for 3 weeks, the annual percentage rate is 174%. I mean, it's a really expensive way to defer that payment. So the next thing to talk about that kind of brings all this stuff together in some ways are the fringe preparers. What I mean when we say fringe preparers, like the sort of outlet you might go to, tax preparation isn't their primary business. It's something like a payday lender, a check cashing place, a furniture store, a used auto dealership. And there's two parts of this. I mean, it may be a sort of business that's using this to make a little bit extra money at tax time, but it may be a business that has a primary business like selling you a car that wants to bring you in both to get that tax time money, but also to knowing that you're going to get a large pot of money, all at once. They want to take as much of that as they can for the product that they're selling. A couple interesting things to note here, I think, are these third-party tax preparation services. So obviously, if you're a fringe preparer and you don't do this as your main business, you may not know a lot about it. So you may use an online preparation product. eTax is an example. It provides a web-based tax interview program, and it pitches it as requiring no tax knowledge and completing a tax return only in minutes, or takes only minutes. I think one notable example of this I sort of dug into last year into some of the training materials they had online was TRS Refund Services. They promote tax preparation refunds as a way to bolster auto sales at over 3,000 dealerships, and I have a quote from them from their YouTube channel with their questions for their customers to the right. And it says, remember, the customer has to bring you those W-2s so that TaxMax can help get you that tax refund money for you. If the customer files their taxes somewhere else, they have complete control of that money. If they bring you the W-2, you have complete control. So, I mean, the business model is clearly sort of zooming in on this, this one-time sort of, pot of money that a household, we're hoping is using to either build wealth through savings or catch up with other bills, and I think zeroing in on it to sell them, another good is their primary business model that we see as problematic. So I think one of the issues that threads through all of this, one of the primary problems you see and hear about through all the mystery shoppers and when you read about this, is the real lack of transparency in pricing. There are often really high fees. There's often no firm pricing beforehand. You can't comparison shop, and they're sort of all over the place. I mean, of course, there are places that are doing it for much more reasonable fees, but if you're only doing this once a year as a consumer, you can't comparison shop because there isn't a price or anything in the window. It's very hard, I think, for a consumer to know what's reasonable. So in the sort of first box here in the slide, you can see, so for the 2015 Mystery Shopper Report from Florida and North Carolina, in the single mother scenario, the lowest fee found was $37. The highest fee found was $427. In the graduate student scenario, the lowest fee was $50. The highest fee was $341. Yeah, so there's a very wide spread of fees there, as I talked about. And I should probably just say very briefly, too, just for those who don't know, when I talk about the scenarios for the mystery shopping, that, so essentially what this means is, someone goes into a paid preparer's office with a set of facts, and they know, given the set of facts, exactly what the return should look like. And then, and then if they're told the wrong thing, they make an evaluation of sort of, whether a mistake was made or what happened. So we see a really high spread of fees from relatively reasonable to extremely high. We know from our polling, which I'll talk about a little bit more in a moment, that we have strong public support for some kind of transparency there. So 9 out of 10 respondents to our poll support an upfront list of fees before the work is done. And there are policy solutions out there. The next sort of box on my slide there is a proposed tax preparation fee box, sort of a Schumer box like you have for credit card disclosures, but for tax preparers. That's from a Policy Matters Ohio report from 2013, where you'd have sort of a menu of what the services are, what they would cost, what you would need, that would allow you to have some sort of upfront sense of what one preparer versus another preparer was charging. And using the ITS as an example, again on the right there, you can see I have a quote, sort of how sort of out of nowhere a lot of these prices seem to be, perhaps to no small extent because people can't sort of comparison shop. So collectively, instant tax services, tax preparation, and junk fees typically average more than $400 to $500 and sometimes run as high as $1,000 for as little as 15 minutes of tax preparation work. And that's from the complaint against them. So this is a real, one of the main issues I think that comes up again and again in this is like no one really knows what this is supposed to cost, and it would be good to have a sense of that. So all these things together I think mean that we need some good regulation, and we have 3 main pillars what we think that should be. One is pricing transparency, which I just talked about, some kind of detailed explanation of service and prices before the return is prepared. Education requirements and competency standards, so tax education, skills testing, continuing education. And this is the pillar that that regulation that exists both at the state level and previously existed at the federal level really concentrates on. And it's extremely important, but I'd like to draw attention to the other 2 pillars too, even though they're much more difficult to implement, but I think the talk that I'm giving you gives a sense of how important they are. And then regulation of credit products and ancillary fees. So codify the ban on the bank RALs and prohibit non-bank RALs. Ban junk add-on fees, allow taxpayers to pay for tax prep fees out of their refund without charge. I mean, I think this is a really important one. Clearly there's a need for low-income households to finance this important financial event, right? I mean, or you wouldn't be signing up for these extremely sort of costly ways to do it. But we do need sort of a policy solution that would allow this to happen. And think about that. So as I said, currently 4 states do regulate. I'm sure as many of you know, the IRS briefly regulated paid preparers, but the Loving decision, the D.C. Court of Appeals upheld the decision finding the IRS lacked the lacked the statutory authority to regulate paid preparers, and so now we need an act of Congress to explicitly give IRS or Treasury the authority to do that. There is bipartisan support for that. In April, Senator Wyden offered an amendment to a bill that tried to address some of the concerns some members have with giving the IRS more authority by housing it in Treasury as opposed to explicitly in IRS. His amendment also addressed, this would be an amendment to allow the regulation of paid preparers, addressed some of the concerns that some of the trade groups for the accountants had by requiring any advertising done around any kind of certification that Treasury or IRS would offer to say, the IRS or Treasury doesn't endorse a certain kind of paid preparer. And there was some bipartisan support for this, though there was a feeling that that amendment would have not allowed the bill that was attached to move forward, and so it didn't happen. I mean, so long story short is, it's still possible. I think there is support for there to be federal standards again. The timeline is just extremely uncertain, and so in the absence, of any kind of certainty on that, we continue to work with partners at the state level who are, educating policymakers, raising the profile of this issue at states, because states can and should regulate this. Even if there was a federal regulation that came in, I mean, there's no reason that state regulation of paid preparers couldn't exist with that in harmony. So California, Maryland, New York, and Oregon all regulate paid preparers to some extent, again focusing on that central pillar of sort of skills, education, and testing that I discussed about. I mean, they all have a little bit different. New York and Oregon probably, I suppose, have the most stringent ones. They all have some kind of those two have some kind of tax-specific education or experience, continuing education, minimum education, and a testing requirement. California requires specific education, continuing education, but no minimum education or testing. Maryland does not require tax-specific education or experience, but does require continuing education, minimum education, and testing. So they're all sort of in that central pillar. We haven't really found a good way, the ability at the state level, though, to address the pricing transparency or the sort of tax products. Though certainly an initial cut at IRS regulation of this probably wouldn't address that either. But I do like to again bring up those other two pillars. So I think they're really important to sort of solving this problem of making sure that at least as it's administered now, as much money as possible goes into the pockets of the low-income recipients. So I'll sort of I'll close up here by talking about some of our polling work that I've alluded to. So I've kind of gone through most of my sort of the equation I started off with you all. So we know we have a high instance of use of paid preparers, high instance of problems with paid preparers, lack of transparency in fees, and expensive tax time products may reduce EITC benefits. The last part of that was public support of regs. So we did a poll last year, and we'll have another one coming out this year to sort of get a sense of what did the public think about some proposed consumer protections or regulations in this sphere, and it was overwhelmingly supportive. So 80% of the public supports requiring paid tax preparers to pass a competency test, with 54% strongly supporting. 83% of the public supports paid tax preparer licensing. And this one, I believe, we framed it either at I think this question was framed so that it was either at the state or the federal level. I mean, people were just sort of generally in favor of some kind of support. I mean, I think one of the things people often say when they're talking about this, especially at the state level where you have a lot of regulation of different occupations, is that, I mean, if your hairdresser has to be certified in some way, it seems unbelievable that your tax preparer doesn't have to be. And there was strong public support for some kind of regime on that. And with that, here's my contact info. If you have any questions about this, if you have any interest in this work, I'm always happy to hear from you. And if I don't have the answer to your question, I can almost certainly at least direct you to the person who does. And with that, thank you so much.
Thank you, Michael. We do have questions, and I think we can address a couple of those. Do you happen to know?
Would you like me to answer some of the questions that I see in our Q&A box?
Well, that, and I have a question before you begin that. Do you have any statistics on how many people who are eligible for the EITC and the CTC actually file their own returns without the assistance of a paid preparer?
I don't, but what is interesting about that question, Marilyn, is that very few people are now preparing income tax returns without some assistance. So whether they use a paid preparer in a face-to-face interaction or a volunteer income tax assistance preparer in a face-to-face interaction, the enormous majority of the population is using tax software. And so it's very difficult to try to tease out who is using, I think the population that uses paper and pencil without any assistance is a very small percentage. And certainly with respect to low-income individuals, it's just not happening because software is out there and folks are using software. So whether you get the software for free online from a number of these groups, including the IRS website, has a free file alliance where you can log into the IRS website, and for lower income individuals, and again that's almost half of the population, with the median of the 50,000, the folks that you can use Free File Alliance is about half of the population, 54,000 or below. And so folks are using either paid preparers or online software that's either free or they're paying for it through picking it up in their local dime store.
Right now, Michael, do you have any statistics on how often people that are eligible for the Earned Income Tax Credit and the Child Tax Credit actually claim those credits? And anyone else, feel free to answer as well.
I don't. I would have to defer.
I actually do have that data, and the IRS website has a great chart state by state on the statistic is described as the EITC participation rate. And nationwide, it's about 80%, which, by the way, is a very high take-up rate for social benefits as compared to, for example, TANF and even food stamps. That's one of the real benefits of the Earned Income Tax Credit and software and paid preparers, is that the take-up rate is quite great. What is interesting on a state-by-state basis, so on the low side, it's in the low 70s, and on the high side, it's in the higher 80s, but nationwide, it's about 80%. The empirical evidence about how the Earned Income Tax Credit is an economic stimulus in low-income communities is pretty compelling. There's a multiplier effect because the statistics are of individuals who get the Earned Income Tax Credit, that they spend it quite quickly in their local communities, and that then creates other spending and tax dollars and really has become a multiplier in low-income communities. As a result, the state of California, I know because I've worked with them closely, and other states and cities, San Antonio, Texas, have enormous outreach events and EITC celebration days to get these dollars in. In my wonderful town of Las Vegas, Nevada, we also have EITC days to try to create this stimulation in our low-income communities especially.
Thank you. I see a couple of questions regarding the idea that if people had fewer children, it would reduce the need for these credit benefits. Do you, Francine, or Alex, or Michael, do you have any answer for that question?
Well, that's an interesting question, but the demographics are such that we really do need workers in this country, and we need folks to be consumers. And so we have a tsunami of seniors. About 10,000 individuals reach full retirement age every single day. And so we've got to balance that with worker bees. As you can see from my anti-poverty charts, Social Security benefits lift many folks out of poverty, and one of the problems there is that we need workers paying into it so the tsunami of seniors can pull out. We're living longer, we're healthier, and for that anti-poverty benefit program to work, we've got to have workers and consumers. So I'm not sure that limiting the number of children is going to help that.
Okay, and Francine, there is a question for you. Why is it economists feel that the employee bears the cost of both portions of the payroll tax?
Great question. Payroll tax is the employer portion of payroll tax, which is 7.65% when you include old age benefits as well as Medicare. OASDI is 6.2%. Medicare is 1.45% to get to that 7.65% that employers pay, and then employees pay the other half. If you're self-employed, you pay both halves, or 15.3%. Economists believe that employees bear this burden because if employers, I guess the empirical evidence demonstrates that if employers weren't paying this to the government, then they would pay it to the employee. So it's part of the compensation package, similar to health care benefits and other benefits. If they weren't paying this benefit, the data seems to indicate that they would pay it to the employees, so the employee is bearing both portions of this payroll tax.
At this point, we'll turn things back to the operator for some information.
Okay, thank you. And for those of you on the telephone who would like to ask a question, please press the star key followed by the number 1 on your telephone keypad. If your question has been answered and you would like to withdraw your registration, please press star 1 on your telephone keypad again. If you are using a speakerphone, please lift your handset before entering your request. And while any callers get in line, we will now give you your ABA participation verification code required in some states to earn CLE credit. Please write it down so that you may provide the code where requested if your state requires it. The ABA participation verification code is 57583800. That code again is 57583800. All right, thank you. And I do not see any phone callers in the queue, so I'll turn it back to our moderator for additional web questions.
All right. Michael, we have a question for you. You say that paid preparers are unregulated. Do you mean unlicensed? that is not tested for competence under IRS code sections 6694, 6695, and so forth?
Yeah, I mean, certainly they are unlicensed. I mean, I think a lot of the, I mean, I guess I was using it more colloquially, unregulated, around the education, the skills testing, and the continuing education. In terms of what the questioner asks about some of the marketing and the advertising, I just don't know what he's referring to. I would have to look at it. I mean, I'll defer to him. I'll take a look at it after the call. Yeah, I mean, I suppose there is a distinction. I mean, there is some regulation generally in the field. I mean, I think a lot of this, I believe, though, that he's talking about refers to what we refer to as sort of enrolled preparers. So I mean, there is, because they're the professionals and can practice in front of the IRS. There is some regulation of that in the interaction. I mean, my understanding at least is that for sort of the people who are just sort of opening a shop, preparing these regulations, I mean, there are very few requirements on them, actually.
All right. And let's see, we have a question regarding problems with given the problems with the advance premium credit in terms of end of the year payments, how would making the child tax credit fully refundable be any better?
I think actually, Marilyn, were you referring to the question about the $500 advance
Yes,
proposal?
I'm sorry.
Oh,
yes.
Okay. Yeah. The reason why we think that one would probably be okay and that very few taxpayers would end up having their advance payment recaptured is the way we've structured it. First of all, they can't get it until July 1. That's halfway through the year, so we feel like at that point the taxpayer should have a much better idea of whether they're going to qualify for the EITC or not. Number two, it's a small amount. So if they get to the end of the year and they made a little bit more than they thought, they may get a lower EITC, but odds are, if they've estimated, they'll probably get some EITC. So, we felt that just making it $500 made it much less likely that the person would end up having it recaptured. I mean, no doubt there probably are a few taxpayers at the margin who might end up having some recapture, but they'll be at the high end of the income group we're talking about. And also it seems fairly unlikely. The previous advance EITC was much larger. It looked at an estimated amount of income for the year, which for these taxpayers is often very difficult to estimate. And it provided it from the beginning of the year on a monthly basis. So there was a much greater risk there that there would be recapture at the end of the year.
All right, a question for you, Francine. Is there any data on the extent to which the Affordable Care Act is moving people out of poverty?
Well, what's interesting about that, and I appreciate the question, is that we've just gotten the 2015 poverty measure data. It was released in late September, and so we're just beginning to tease out each of the components. It's clear that approximately that there was a significant decrease in poverty. 1% doesn't sound like much, but that's a significant decrease because it's been very static over time and actually increasing during the Great Recession. So we're just trying to tease that out. And I received the name and school of the person who asked that question, and I hope to be able to give him more information as we're able to understand better each of the components of the supplemental poverty measure.
All right. For any of you, is there any effort to require agencies that receive federal funds to assist clients with tax preparation or claiming the earned income tax credit or the child tax credit?
Well, Congress does appropriate federal grants for volunteer income tax assistance on an annual basis, and the recipients of these grants, which the total program is at least $10 million a year that's allocated across the country. The recipients, of course, have to provide these services, and they are audited on a regular basis, not only for the volume of their activity, but also to make certain that they are tested and that they're providing competent and complete assistance. So there are federal grants to provide taxpayer assistance for free, as well as I mentioned previously, the IRS website itself has a link to Free File Alliance. That's a program that has been around for perhaps as long as 10 years now. It's a public-private partnership, so it's the Internal Revenue Service has partnered with private paid preparers like Jackson Hewitt, H&R Block, TaxSlayer, on, and they have agreed to provide free online tax preparation assistance, and the IRS has basically agreed not to compete with them by providing its own tax online software. And any of your clients can access this online through the IRS website. It takes you off the IRS website into a website that allows you to select among and between these many different programs.
Do any of you have statistics on how long people are using these credits? And I would add to that, is there any time limit on how long the credits can be used?
There is no time limit except age. You know, families might start to age out as their children reach maturity. But what is interesting about the empirical evidence is that people cycle in and out of poverty, as Alex was saying. It's very dynamic. That is one of the challenges of the Earned Income Tax Credit, in that the goal is that you're pushed out of poverty and into a higher income. And so folks who are suddenly of the Earned Income Tax Credit is a subsidy are not as familiar with it, and so the complexity is exacerbated because people are moving in and out of it, in and out of poverty, and qualifying for it or not. So it's very dynamic, which adds to potential error rates because of the complexity and because it is a safety net, not a crutch.
Francine, you have been working with the tax section's pro bono tax preparation program for some time. Could you tell folks just a little bit about that very quickly? I think we're about to wrap up, but I think we should let them know about this.
Yes, one of the many things that the ABA tax section does for low-income taxpayers is that we work with the members of the armed services. One of our wonderful programs is to train the members of the armed services who actually prepare income tax returns for their fellow soldiers. And we have a nationwide Adopt-A-Base program where individuals go out and train the trainers, and it is incredibly rewarding, and it's exponentially beneficial because these individuals then prepare many tax returns for members of the armed services, and many of those, Private Ryan, as I've described in some of my scholarship, their demographics are key to the Earned Income Tax Credit and Child Tax Credit because they often are married with children and a lower income taxpayer.
We just received one last question. Why are the increased costs for middle-class families between 2010 and 2012 not reflected in rates of inflation?
Could you repeat that question? I myself didn't understand that.
Why are the increased costs for middle-class families between 2010 and 2012 not reflected in rates of inflation?
I think that the person who asked the question is referring to the data that I cited. And those costs were, let's put it this way, my understanding from the economists that did that analysis is that they were able to make that assessment in real terms. So it doesn't include the inflationary cost. It's over and above inflation because those particular costs are subject to factors other than inflation.
All right. Thank you. I think that's all the time we have now. And I really want to thank all of you speakers for sharing your insights and your information with us. Before we sign off, I will ask all attendees who want CLE credit to stay connected for instructions to receive your CLE certificate. And on behalf of the ABA, I'm Marilyn Harbour, thanking you for joining us. Before closing your browser, please wait for the evaluation to appear on your screen. Thank you, and I will now turn it over to the operator.
Thank you, Marilyn. You can submit additional questions to the panelists on the webinar question form for this program. A link to the form is available on the webinar attendee page. MCLE state regulators require CLE program evaluations for CLE accreditation. Your comments and suggestions are also important to us in shaping future ABA events. Please click on the link now appearing in the presentation window. This will open the program evaluation. After you submit the evaluation, the attendance confirmation form and request for CLE credit will appear. Please complete the information requested on the form and submit. Your information will be verified, and if your attendance meets all the requirements for CLE credit, your certificate will be emailed to you. On behalf of the ABA Tax Section and Economic Justice Committee of the Civil Rights and Social Justice Section, thank you for participating in this program and have a good day.